Three, two, one.
Welcome to the first Pepperdine Private Capital Markets podcast. We're your hosts, Shawn, Purcell, and Alan Lewis. Today's podcast is called 8.5 Things Every Accredited Investor Should Know About the Private Capital Markets. In this inaugural podcast, we have the pleasure of talking with Robert Slee.
Rob Slee is an author, investment banker, mentor, and business owner. Rob has authored more than 500 articles on private finance topics in a variety of legal and business journals. Rob's book, Private Capital Markets, published by Wiley, is considered the seminal work in finance for private companies. Rob has authored Middle Market M&A, Midas Managers, Marketing, and Time Really Is Money, among his many works. Rob has owned equity positions in dozens of private businesses, and in 2015, he founded his first unicorn. He has also mentored more than 100 companies. For more than 25 years, Rob has also been president of Robertson & Foley, a middle market private investment bank. In that time, Robertson & Foley has advised on billions of dollars of capital raises and exits.
Rob has taught at Pepperdine University since 2006. In 2008, he founded the Pepperdine Private Capital Markets Studies, which are now considered the most important source of capital formation behavior in the world. He is a Phi Beta Kappa graduate of Miami University and received a master's degree from the University of Chicago and an MBA from Case Western Reserve University. Rob's most important work and what he is best known for is the father of Jen and Jesse Slee, his identical twin daughters.
In this episode, we'll be asking Rob a series of questions aimed at providing individual accredited investors with the knowledge they need to succeed in private capital market investing. So whether you're new to private investing or a seasoned pro, you're sure to gain valuable insights and practical tips from this podcast. So let's get started. Rob, thank you so much for joining our first podcast.
Thanks, Shawn and Alan. It's just great to be here.
All right, so I'm going to jump right into the first question here. Would you mind beginning by telling us more about yourself and your background as an investor, entrepreneur, and educator?
Well, I grew up in a family of entrepreneurs. My dad was a serial entrepreneur before the term was ever created. So I was running family businesses at a young age, and it just took. And then over time, I was the first one through to diagram what really is the behavior of the private capital markets. So I did a lot of speaking and writing so I could figure it out. It was more me figuring it out just ahead of the audience. That's why I did all the articles and all the speaking. Yeah.
So Rob, can you briefly describe what private capital markets are and how they differ from public markets?
Yeah, I wrote a five-pound textbook called Private Capital Markets. It does all this, but I'm gonna describe it in about 30 seconds. What private capital markets are: a market where equity and debt interests are raised and traded. Traded meaning exchange. It's an important thing in that more than half the world GDP is generated by private companies, closely held companies. I'll be using private and closely held interchangeably. Probably 70% of the world's employment is generated by private companies. The big differences between public and private are risk and return, and this is the biggie for our audience. Risk and return are balanced differently in public versus private. What I mean by that is, from a return on equity perspective, a public investor could expect maybe a 10% return on equity. That's been the average investing return over the last 30 years for public investment. For private, you have to expect, it's much riskier. So you have to expect a 25 to 35% return. So it's, in other words, it's 2 to 3 times more risky in the private side than the public. The other big difference is liquidity. Once you're in a private market, because there's no private company, there's no ready-made market for your shares or your interest, you may be locked in forever. There's no easy way to sell a private company's interest. So those are the big changes. Now, like I say, there's, I could go on for 8 hours just on that topic, but that will get us there for right now.
Well, quickly, before we transition to the next question, what about access in terms of the type of investor, like a accredited versus a non-accredited investor? Can you speak to that quickly?
Well, yes, accredited investors really are. I mean, if you're going to follow the law in terms of securities exchange and the other federal and state laws, you really should just be going out to accredited investors for certain types of raises. There's a whole framework, a legal regulatory framework around this. I'll tell you though, most of the time, I don't think that people dot the I's and cross the T's for this, but they should, because if they don't, and a non-accredited investor sneaks in, or they didn't, that whoever was promoting the project didn't do a thorough job of examination, who's coming in, it can upset the entire deal later. So the investor actually has some legal rights to, hey, wait a minute, you didn't give me the right paperwork. I can get out of this investment. So for all purposes and all reasons, the promoter of whoever's raising the money really needs to pay attention and follow the rules on this, because if they don't, it's big legal trouble.
Now you spoke about the risks of investing in the private versus public markets. So, given that, why do you think an accredited investor might be interested in participating in the private capital markets?
Well, in some cases, the investor can take advantage of all these inefficiencies in the private companies, because you don't always have great information, and it's like pulling teeth sometimes to figure out what's really going on in the company, these private companies. But if you're located, you're in that industry, you're working in that industry, or you have access to consultants to that industry, there's a lot of inefficiencies that you can gain. So when I say that the 10% return to public on average and 30% for private, that if you can hedge your bets and really understand what you're doing as an investor, you can make a lot of money in the private markets. I mean, I have, and just because I always sort of tried to hedge my bets and benefit from the inefficiencies, you might say.
Right. And yeah, we could probably both keep talking, but diversification is obviously an important factor
Yes.
too, right?
Yes.
Yeah. All right, Shawn.
So, Rob, what are some of the advantages and disadvantages of investing in private companies compared to publicly traded ones?
Yeah, the big advantages are so much of the disruptive technology in the world today starts out from below. It comes up from the private companies. And if you're fortunate enough as a potential investor to see one of these and understand it thoroughly, you can get disproportionate returns. You can get 100x returns on these early stage plays. Another big advantage is you get closer to the management as an investor to a private company. These public companies, you may never talk to one of the senior managers, but these private companies, they're available, accessible. There's a big home run potential on the private side. With the risk comes the possible return. The disadvantages are these private companies are way risky. You can lose it all pretty easily if you can't hedge your bets on this, so either through diversification or added knowledge, special knowledge about that industry or situation. You don't have liquidity on the private market, so you have to have a long-term view on these. I mean, you may be in these 10 years. And I've owned some interest in private companies for a lot longer than that. Probably I would have gotten out before, but it's just not a ready-made market. You look at the private investments, especially the startups and early stage stuff, pre-revenue and all that, as almost a lottery pick. You're playing the lottery kind of. So I mean, if you're going to play that game, spread out 10 equal bets because you're probably not going to be able to see through any one of them.
Right. Great. Um, with the lack of information in the private markets, imagine valuation, really understanding, the differences between like a fair market value and a publicly traded company versus, I don't even we call it FFB and a private, right? It kind of
Yes.
depends on what information you have access to. Um, so could you expand upon the concepts of valuation of the private capital markets and how it's different from the public market?
Yeah, this is the biggest difference from a quantitative perspective. As you indicated, the public markets has one true real-time value that's as is big enough to be traded regularly. Whereas the private companies, and this is sort of a shock thing, but like I said, I've probably got 150, 200 pages in the textbook just on this topic. Every private company is worth several dozen different values at the same time. Now, how is that
Right.
possible? I mean, and I prove in the textbook because I take one company, Main Street, something or other, private co, I call it, and I run it through all these what are called value worlds, what I call them value worlds. And depending on the perspective of how you want to view this, there's a fair market value of that company, there's a market value of that company, there's an owner value of that company, there's an investor value, an insurance value, a bank value, a venture capital value. All of them are legitimate, and all of them have a dramatically different value from each other. And so when you're in the private market, you have to understand, okay, what's the perspective of who's looking at the value and why? Why do I need to know the value? And as an accredited investor, you generally be looking at market value because of what's it worth in the open market. And that has a unique way of determining value as opposed to bank value or, venture value and all that. So it's really important to make sure that you're at least read a couple articles before you invest in something. How market value is determined in a private company. That's really important. We don't have time now to determine that, but that's the big difference between private valuation and public valuation.
Great. Well, hopefully we can dive in that more in another episode.
Yes.
So, Rob, with all the risk potential with private markets, what are some of the key factors that investors should consider when evaluating a potential investment opportunity in those private capital markets?
Yeah, the number one thing, and the thing I stress, because I look at deals a month of things I'm not involved in right now, but opportunities to invest. I'm an accredited investor, and I look at opportunities too. The number one thing is the management, not the project. So don't get caught up in the project. Look at, has the management created substantial market value prior to this, either in that particular opportunity company or something they've done in the past. This is not a good time to be an investor in a first-time management because it's management teams learn. Like I've learned, I've owned parts of 100 different private companies, and you learn, you get better at it. And unfortunately, it's failure. A lot of these stops end up being failure the first 2 or 3 times you own a private company. You just got to figure it out. And over time, you're doing that on your money and other people's money. So management past is the big thing. Startups almost always fail. So be careful with startups, even if the managers are very good. The best place to go if you're a private company or a private investor, accredited investor, is to look at the could-be public companies. So these are sometimes called secondary markets. The could-be public companies like before Facebook and Twitter went public. There'll be certain funds that have those opportunities. Those companies are usually have had a number of series, meaning a number of investment rounds. They've gone through, the management teams have been tested, and they're generally a little bit larger too than these other companies that you might see opportunities for. If I was going to invest in anything as an outside investor, I'm usually involved with the management. But if I was going to invest as an outside investor, I would be looking at could be public companies that they plan on going public in the next year or 2 or 3. Those are the ones that I think would have the most merit.
And they're venture backed.
Yes, they already have an institutional investor involved, so they've been what we call the business scrubbed. They've been scrubbed of, there's some transparency to the business model of the company and the management team.
Sure. Well, that's actually a great segue to what may be a little bit of a tangential question, but around private equity funds. I think it's good to hit that just because of their recent participation in terms of pooling accredited investors, for the deployment, whether it's primaries or secondaries. So would you mind elaborating quickly on kind of how private funds operate? If an investor is going to pool their capital, what are some of the risk benefits to that?
Yeah, there's a couple different ways to go about that. The private equity groups and the venture groups tend to do more institutional funding, large institution banks, insurance companies, all that. But there are a number of pools that pool investors. So then you're riding with the manager's ability to select good investments. I prefer as an investor to go into specialized theme investments, you might call it. So the manager of that fund, who's pooling the accredited investors, is just investing in artificial intelligence positions or just investing in telecom or, sort of a thematic industry investment because they may have and should have inside knowledge. I don't mean inside trading information. I'm not talking about that, but inside knowledge of where the industry's going and what a good opportunity is versus a bad one. That's one half of the side of the coin. The other half are generalized investments. I'm not too big on a pool that does just generalized companies. It could be a company in any industry. It's really hard for a manager to see through the risks and return opportunities of a generalized fund. So if I was investing, I'd look for almost a thematic industry pool. That would make more sense to me.
Yeah, sounds like it's just important as the management team to the company, the manager of the fund, their subject matter expertise.
Exactly, because they can hedge, they can better identify risk and return and that arbitrage situation of, all right, we're paying so much, we're going to get so much more back. They're in better position to determine that than an outside investor.
And disclose it, hopefully.
Yes, exactly.
Yeah. Great.
So, Rob, can you discuss the role that due diligence plays in private capital markets investing? And with that in mind, what are some of the key things that investors should be looking for?
Yeah, this is really the tough part because there's not as much transparency in these private companies, both about the company, about the managers. I would interview the team if possible. If you're doing a direct investment into a private company, I would interview the team. What have they done in the past? What are they doing now? Knowing that here's the news. Every company I've owned that's grown to substantial size, we had to pivot. The managers of that private company, we had to pivot 8 or 10 times before we got to the promised land. Well, that's pretty much true with all these private companies. They don't start out where they want to end up. They sort of find their way. It's almost like Moses in the desert almost. You go here when that didn't work. You go there, nobody's eating the dog chow. And you sort of work your way around the desert till you finally find it. And so the best you could do is interview the management team to say, look, if you've had experience pivoting in a private company, because they're going to pivot because nothing works right the first time. It's like anything disruptive. These are typically disruptive companies. I would have an outside industry expert look at the investment opportunity, hire a consultant, find somebody that knows about that industry so they can tell you they're either just full of it or no, they're heading in the right direction. There are people you can hire. Just do an internet Google search. You'll find some people. I would hesitate to do startups or early stage investing for the reason I said before. You can't do enough research. It's sort of like playing the lottery. You can't do enough research to hedge your bet. It's so risky that there's no amount of research you can do that's going to help you make that decision. So I would be real hesitant. I would tell most accredited investors, don't do an early stage and don't do a neighborhood play where they're passing the hat around the community and, Bob's a good guy and all that. No. Money doesn't want to, money doesn't care about good people. It wants, efficient, effective managers, not just because Bob's a good guy. And so be real careful about the early stage community stuff. That'll get you in some trouble.
Yeah, you're talking about later stage, and not to plug other third-party providers, but there is some information out there if investors want to subscribe to like PitchBook or Crunchbase or even some of the bigger private equity funds are really trying to access as much receipt out through like 409As and different filings that are publicly available to try to figure out some idea what that valuation is on a non like secondary market basis.
That's why I'm trying to push people listening to this to more of that sort of investing as opposed to the community in your town, that early stage, the guy's got an idea. Oh man, I'm telling you, I've lost more money. Somebody's got a great idea because it's not the idea. It's the managers, the team. It's not the idea. Or as you get later stage investing, like you're describing, it really, the idea's already been poked around already. Somebody's already eaten the dog chow, and you have a lot more information to go off of to make a sound investment decision.
Sure. We talked about diversification a little bit earlier. Can you expand some more on that in terms of investing in the private capital markets for accredited investors and maybe a strategy or two that an investor could use to achieve diversification?
Yeah, I tend to want to invest and now only invest in those areas where I know. I've owned so many different industries. I tend to know where stuff is moving right now in certain industries. So I'm not a all industry investor. There's probably 8 or 10 industries that I'm comfortable with. So either invest in what you know because of what you've done in life, or where you can get a professional to help you. If you can't get in that position, you're not in that position, then you need to diversify at least 8 or 10 investments. So like, don't go all in on something. I'm telling you, you're
Right.
It's like playing crypto. If you go all in, you may hit, but chances are you're not going to hit. So I would diversify. A typical sort of diversification strategy, like size investments in a certain period, I would still try to get an expert to help me with that, even with the diversification strategy. But you can't be too careful in this because even the could-be public companies are extremely risky relative to like a Microsoft or, something like that. And so you just got to understand what's your risk appetite. That's really what you have to understand. And don't put your whole all your money in your estate, all your funds in this sort of stuff. This is the end of the line. This is the 5 or 10% of your portfolio goes in this sort of stuff, not the 50%. You'll get in trouble if you do that.
Right. Like we were talking about prior to starting the podcast, often what's overlooked in these conversations, particularly with like YouTube influencers and things these days, is working with a registered
Yes.
investment advisor or a registered broker if they're on the stockbroker's side, to make sure that they're doing know your customer suitability and only allocating a small percentage of your portfolio, within that kind of 10% risk threshold for most investors. And as you and I were talking about, I mean, it may be less depending on, the particular profile of that investor if they're working with a professional that's truly following the law and working on behalf of their client's best interests, right? So,
Yeah, I agree with all that. I don't want to sound like I'm just so negative. I mean, I've spent 35 years in the private market, so I don't want to seem like,
right.
oh, don't go near this. I mean, it is half the world economy, but I do want to say this is a time you really got to be smart about stuff because these are risky investments. That's all there is to it.
Sure.
So,
So with all the risk and all these potential pitfalls, what would you say are some of the most common mistakes that individual accredited investors make when investing in private capital markets? And how can one avoid those?
yeah, the biggest one is they underestimate the investor, and I've done this too. They underestimate the length of the investment horizon. If you invest in some of these institutional pools, you may be locked in for 10 years. And it'll say there, this isn't something you have to guess at. It says in the paperwork how long until you can start getting out of the investment and make it gradually even. But if you do a one-off investment, you fall for it. You fall for Bob's local company and he's going to start a brewery or a microbrewery or something. Chances are you're in that for a decade. And chances are that you're not going to like what happens at the end of year 10. So just don't underestimate the length of this investment horizon because these are long. This isn't like IBM, you're in today, out tomorrow. It doesn't work that way. The other thing is, like I said before, is there's so much betting on individual projects and an industry. Like AI is real hot right now, and I've been an investor in a large AI company, private company, for about 8 years now. And I got to tell you, there's a lot of room to fail within AI. So just because somebody's promoting an AI project, don't fall for that. Go, once again, bet on the management team. What they've done in AI. Do they have a 10-year track record? That kind of stuff. And don't underestimate the risk because you are not in the same risk profile now as any other investment you've probably made. So when I say 30%, just think about what that really means. If it's a 30% equity risk, that means every other year you almost have to double your money. Well, now what kind of investment does that? And that's what we're talking about. That's how risky this is, that you'd have to effectively almost double your money every other year. Now you tell me, and if you've been an investor for 20 years, how many times have you done that? And that's what we're talking about here. That's how risky these are. Now, every once in a while when you do it, it's quite memorable, obviously, but it's not something you can count on. That's therefore the diversification policy. But that's what you're in for here.
Yeah, even with the later stage retail investors, they seem to be bringing in these like public market liquidity ideas into the private investment. I mean, to me, in my particular practice with this group, when newer, as platforms emerge and rules are loosened and what have you,
Yeah.
they seem to think that they could just trade in and out of this, that they have direct access, particularly when they're being pulled and things. And it's turned out to be quite an interesting exercise trying to inform them, like, this is not the public markets, folks.
Right. Yeah, most people they've never done the private thing, but it's in vogue right now. The private thing's in vogue because, and here's the reason. This is probably something we really ought to talk about for 60 seconds. Many commentators think the public markets are a dead money bet for the next 10 years, the next decade, for a variety of reasons. Who knows if they're right or not? But what's happened is that's caused just that talk on, CNBC and some of the other places, just the talk of a dead money bet for a decade. What's happened is now say, well, I don't need to take that. I'm going to the private side. And we've seen trillions of dollars allocated to the private side. And that's a very dangerous thing, the private side, because that's too much money chasing too few good management teams. There's only 1 out of 10 management teams I've seen in my 30 years of doing this that I would feel comfortable putting money behind. Now, wait a minute. You got $1 trillion chasing that 1 in 10, that means that if you do involve one of those, you're going to be overpaid for the privilege of being an investor. So the private side can only suck up so much of this excess liquidity, we might call this investor liquidity. And I think most people are going to be very disappointed with their 10-year returns on the private side for that reason.
Yeah.
It's very risky stuff, and there's very few management teams that you should bet on.
Yeah. Yeah, we have a saying in my firm, similar. It's a kind of a three-part, but you want to bet on the jockey, just who you're describing, the
Exactly.
horse and the race, and those kind of three things have to fall in line. If in those earlier stage companies. One more question for you. We're a little ahead of schedule, so I feel it's a little unfortunate because I love this conversation. I want to talk to you further. But we are at our last question here. So, can you share some insights into where you see the private capital markets headed over the next 10 years or so, and what opportunities and challenges investors may face?
Well, the makeup, one thing I just passed right by is the makeup of the private markets. They're not a uniform market. What we have here are the small businesses doing less than $5 million a year, generating less than $5 million a year in revenues. We have what's called the middle market, and that's typically between 5 and 150 million, 5 and 500 million, something like that in annual revenues. And then you have the sort of the large company market above 500 million in revenues. People define those in lots of different ways, but for our purposes, let's do that. Well, the middle market makes up about a third of the U.S. economy, the 5 to 500 million in annual revenues, and that is predominantly owned by baby boomers, and they're in the next 10 years they're heading for the exit. Now, whether they can sell their business or close their business, whatever they're going to do, there's going to be a big change in the middle market in the U.S. We have the world's largest middle market. Most of my writings, by the way, talk about and describe the behavior of the middle market. I'm a middle market person, medium size. It's sort of Goldilocksian. I'm in the middle. The small business front, the under 5 million, is what I'm suggesting the accredited investors need to be very wary of, because there's not much ecosystem infrastructure in those small businesses, and you're totally relying on usually one person, and they may or may not be successful. Probably won't be. So the middle market's about to change over. Now, what is going to happen there? No one really knows, because we've never faced this before. The U.S. has never had middle market as large as it is and as big of the GDP as it is. The millennials do not want to own businesses to the same percentage degree as past generations. There's a lot of different reasons for that, and mainly it's because they saw their parents as business owners and what a miserable life they had. Because as a business owner, I can tell you it's a miserable life. I mean, you do it because it's in you. It's like the salmon going upstream. You do it because the big company wouldn't have you anymore. They booted you out. I mean, I'm describing myself, of course. And so that's who ends up owning companies. It's often not by choice. I mean, it's what's left. This is what I have to earn a living, right? I have to provide for my family, myself. And so as the boomers march out and retire in one form or fashion, it's going to be very interesting. I would be very careful placing bets with boomer-owned businesses, because they're very risk averse at this point. So chances are you don't want to place your bets there because they're not going all in on their business anymore. I can't say that uniformly, but I just did because I'm in that market. I kind of understand that. So the early stage stuff, I'm big on disruptive technologies. As long as the managers have done other stuff, you're going to see more of that. So what we're going to see is fewer unicorns, those companies that are worth $1 billion, pre-revenue worth $1 billion or valued at $1 billion. You're going to see, I believe, fewer unicorns, but bigger unicorns, called decacorns, being worth over $10 billion. Because when you have a disruptive technology now, boy, you could make it happen. Like some of the stuff I'm doing in AI, it gathers and captures so much of the market so quickly that that's drawing a lot of investment money and will continue. So those are the sort of things you want to look for: a disruptive technology that the managers have some reason you want to bet on them. So that's one thing. AI is going to dominate every single industrial space in this next 10 years. I can say that because I'm in it in every industrial space. I know what it's doing. It's changing the rules of business. It's just now coming out of the labs to do this, but I've been doing it for 8 years in probably a half dozen different industries. And I can tell you that once it changes the industry, it's never going back. We're not going back to Like I'm in AI and for cannabis cultivation. We used to have 100 employees in one of these facilities to generate 15, 20 million in business. Now I need a third that many because the AI is actually managing the growth. And what we're going to see and what I'm suggesting is going to happen here in every single industrial segment, I don't care what it is, you're going to see AI be part of the business model. So don't place investment bets where thinking that AI isn't going to affect it. It is. So understand how AI is going to affect it. And I personally would be most interested in those early stage bets, especially that demonstrate how AI is going to affect the following industry segments. That's where I would go if I was invested, and frankly, that's where I am going. I would. The next 10 years, it's going to be more about niches, because as these disruptive technologies come out, they're not trying to disrupt everything. It's not AI for everyone. It's AI applied very specifically for for specific purposes. And those could be some really good bets because you could demonstrate to some degree early on that that's going to have the desired effect. So if it's me and I'm an accredited investor and I have one and I look at stuff and somebody comes to me with the project that the management team is seasoned, they come and say, okay, we've developed the following AI to influence the following segment or niche. I'm all ears, because that tells me that, it may be a niche to begin with, but then maybe you can replicate that in 10 other niches that are very similar. And then, big public companies want to buy you go public, you can do SPACs, you can do any of a million things when you have that sort of setup. And those are the sort of things I think in the next 10 years are going to be very AI centric. And it's going to be a very interesting time for all business because we're not used to this. Whenever there's a new set of rules, it takes us a while to get used to it. And this AI, for a lot of people, they don't quite understand that this is changing all the rules of business, at least for the next 10 years, at least.
Yeah, we facilitated some employee exits of companies, I'll leave unnamed for various purposes, that took the money from selling their stock to us to start some AI businesses out of Silicon Valley. The vision of the future that has been painted is like, and in particular comes to mind is farming. So it's funny you mentioned cannabis. Really either dystopian or beautiful, depending on how you look at it, right? But we are out of time, so I hate to end it here, but have to do my obligatory podcast duty here. And hopefully we'll get a chance to pick up the conversation, explore some other topics. We did title this inaugural Private Capital Markets podcast. I did that in honor of your previous experience at Pepperdine. So hopefully that'll help plant a seed and we can continue the conversation in future podcasts. So it's been an honor, Rob. Shawn, closing questions or thoughts?
No, I think that, Rob, it's always great to hear your expertise and background, and it just gives such a clear picture for people who are very experienced and also people who are just new into it, or even people that have no experience. I feel like it's really concise and concrete and very easy to digest. So I really appreciate that a lot.
No, I appreciate you guys inviting me. It's been fun talking about this.
Great. Any closing thoughts, Rob, before we stop recording?
No, just what I do every night to educate myself further. I mean, this is going to sound bizarre. I watch a dozen YouTubes on where AI is infiltrating various niches every day because, I'm involved in this and I'm real interested in what other people are doing with AI. And so that's how I keep up on it. And I talk to a lot of people, but I watch a lot of video of where people are at, what they're doing.
Great. Well, again, we appreciate it. This has been 8.5 Things Every Accredited Investor Should Know About the Private Capital Markets with world-renowned author, Pepperdine professor, Dr. Alum, Robert Slee. Thank you.
Thanks, guys.